What's up, guys? It's Rowan
and Terry
here from Artist Smart Education, bringing you another episode
of the HSC Economics
Review. In this episode, we're going to be evaluating the effectiveness of monetary policy in 2024. And one of the things that we thought would be really great to show you guys how to do is how to evaluate monetary policy from the perspective of looking at, on the one side, right, the case for why it has been effective this year in achieving its objectives. But then playing devil's advocate and looking at the other side, how equally you can argue that it's also been limited or ineffective even in its ability to achieve the objectives. And this goes, I think, Terry, to the point that good analysis of effectiveness of policy, even discussion ultimately of the effectiveness of policy, really turns upon needing one to, I guess, identify a more nuanced perspective, not it's only effective, it's only ineffective, but really finding the sort of grey areas that sit in between that, but also in presenting both sides, different perspectives about a particular policy. Is there anything you want to add, Terry, before we sort of jump in and unpack this?
Yeah, it just makes me, I guess, wrong when you said that about the discussion and the unpacking of the grey areas. It made me really think about one of the questions this year, in this year's HSC, one of the essay questions, which was really to discuss the usage of micro and macro policies in achieving specific kind of economic objectives. And I think, some of the conversation surrounding that has been that the students who have done better in that have really actually taken the courage to go and really navigate the fact that there are often two competing sides of an argument, whereas students who have probably not been as daring to go into that territory have probably not done, probably won't be as happy, I guess, with their mark. And so I think it's probably a thing which I think, Rowan, you probably see when you're teaching students here at Artist Smart as well, is that they're just a little bit unwilling to kind of go with both sides. And I think it's a really important part, and I think it's really lovely what we're going to do today, where we are looking at things from both the positives and the negatives. In a way, it's a nice way to do a Spotify Wrapped of the RBA
for 2024. It really is. Yeah, that's right. And so I think the crux of it is exactly, you get this skill that we're going to be unpacking, but with, obviously 2024 and monetary policy as the example, you get this skill and you master it, and I think it's really the pathway to unlocking those higher end marks in the ECHO course. So let's jump in with that. And I think before we sort of unpack, the for, why it's been effective, and then the against, why it hasn't been, I think it's very important to quickly remember what the objectives are. Because at the end of the day, when you're evaluating policy, you've got to evaluate it against the objective. And I think what's changed certainly in how you should be evaluating this year is that, I think in the past, obviously there's been multiple, 3 core objectives, but the inflation target was primarily the core priority. And the RBA review, right, that was completed in 2023, really highlighted, with the recommendation to make the dual mandate of both, price stability and full employment much more explicit. So I think what that means is that, I think it's complicated in some ways, the RBA's sort of policy making a little bit, because they need to much more explicitly themselves sort of account for the impacts on, the labour market. So I think when we're going through some of what we're unpacking, we're going to speak to that as well in terms of just that conflict ultimately in the objectives that they need to somehow walk a tightrope in balancing.
Yeah. I think, Rowan, you're already kind of touching on that aspect of some of the limitations and the negatives, if you will, or the case against, right? That it is one of those points in the syllabus, within this, built into the syllabus, of that conflicting objective. So I think it's interesting that the RBA themselves have also, I'm not sure if they took a peek of the economic syllabus, probably not, but they're actually acknowledging the fact, that there is this dual mandate, and it is very difficult. And I think, just to drive it forward, I think what you guys need to be capable of doing is to say, well, I first of all acknowledge that there is this mandate, but then what does that mean? Right? So
very quickly as well, let's just make sure we're all on the same page about what the stance is of the current monetary policy. And so I think, when we look at it, we've got a cash rate of 4.35%, and it's been that way really since November 2023. So all of 2024, we can say that every meeting the RBA came by and we're waiting for a decision, and they just held every time. So I think ultimately when we're evaluating, therefore, the stance, we're really looking at what is, a contractionary stance, okay? and one that has remained unchanged over the 2024 year.
Yeah, Ron, just a little curious real quick. When you say that they haven't changed it, but you've still said it's a contractionary stance, do you mind just unpacking that a little bit for maybe some of the viewers?
Yeah.
In the textbook, there might be a customer going, oh, they've got to be increasing it for it to be a contractionary stance.
So I think there's a couple of sort of things there. One, I think, is the way we're defining it as contractionary, I guess, is to look at what has been the change in direction of the cash rate over time. Okay. So if we zoom out, not just in 2024, but we zoom out certainly since 2022, you know, we've had, I think it's 13 successive increases in the cash rate, right? So I think when you see over what is still, you know, a relatively short period of time, you know, really 2 years, 2.5 years, we've had 13 increases. I think that's how you would still characterize, therefore, contraction. Now, there is some other stuff, and we start to look at the neutral rates of the cash rate, and which we're going to talk about later in today's episode. We're going to understand a little bit more about how we can still, even if a cash rate remains unchanged over a long period of time, still determine whether or not the impact is contractionary or not, right? So there's some more stuff we can unpack there.
Yeah, because I was curious. I was thinking, I had a question back on one, which was that how long if you keep something the same, does it stop becoming contractionary?
Yeah. So that's a good point. We're going to unpack that. Cool. So let's jump in and let's start now with how. Actually, I should very quickly, before we jump in and argue the case for why we think it's effective, I think one very quick note is ultimately monetary policy is not now, you know, sort of defined in a vacuum, right? Like we do really look at the globe, right? The global economy, and in fact, that's sometimes one of the things that you can bring up even in your analysis of policy is to what extent are we in alignment with global monetary policy, to what extent are we at odds with it. So I think really quickly it's important just to go, great, how does our current stance, we've just said contractionary, right? How does that compare with the rest of the world, Terry?
Yeah, so just the broader numbers, as Rowan said, 4.35 is the magic number here in Australia. And it's really interesting because it's actually lower. It's actually still lower than other parts of the world. However, speaking to what we were just saying about the fact that we're contractionary because we've gone up but we haven't come down. But in other parts of the world, they've gone higher, right? Now they've started to come back down. So some people might look at that and go, well, they're maybe being a little bit more expansionary than us. So I think what that speaks to me is that it's not necessarily just about the number per se, but also kind of the direction you're heading. And so as I said earlier here, the numbers are still higher in other countries. So to give you an idea, the US, their Fed rate is between 4.5 and 4.75. New Zealand, they're looking at 4.75%, where they've decreased by 0.5% since October.
So recently.
Very recent. Britain, they're at 4.75%, whereas in July they were still at 5.25%, so they've come down a fair bit as well. And finally, Canada is actually all the way down at 3.25%. So outside of Canada, we're still lower than all these other countries. However, I guess you could say in that recent kind of 6-month period, there's been a very rapid...
There's a shift to an easing cycle, really, isn't there? Right, with the exception of I think like Japan, who you know, doing their own things. Let's not go there. That's like a whole. Other
Did you ever hear that quote? I just want to share this one. It's very quick. There's 4 types of economies in the world. There are developing, developed, Japan, and Argentina. Have you heard that one before?
I haven't.
Well, yeah, mate. I don't know. Maybe drop that in one of your essays.
Yeah. That'll definitely get you a laugh. Maybe not an extra mark, but at least a laugh.
Yeah, I'd get a laugh if I read that. I'm not gonna lie.
So that's just, okay, what we sit. That's like the global context, right? Let's keep that in mind now as we jump in. So let's make the case, Terry, firstly, why monetary policy has had an effective year in dealing with the objectives.
Yeah, this is going to be a tough one to argue, Rowan, because I think if you go into most classrooms and you go to most, and you read any newspaper, right? Yeah, it's all been very critical. So
they have.
Let's give it a go.
I think
it's going to be a tough one.
Cool.
I'll start with the. I'll go for the open goal first.
Yep.
The open goal is, as we know, yes, we have a dual mandate now, but as we've known all along, that price stability goal of between 2 to 3% that the RBA has always maintained since the 90s, we've actually recently gotten back in there. So to give you the numbers, in the September quarter, our annual inflation, which just compares what prices were in the September quarter of 2024. Comparing that to the September quarter of 2023, they rose only 2.8%. Okay, so that means it is within the RBA's acceptable 2 to 3% range. And so if you were to look at this in a very basic, I guess, unnuanced way and just go, oh, look, the number is in the right range, then you could make the case that the RBA has had a good year.
And I think it's important to highlight that because I think a lot of students do make that mistake. You know, they look at, oh, great, it's in the objective, cool, tick. You know, like,
or on the flip side, not
out of the objective, oh, it's
bad.
ineffective. Yeah, exactly right. And I think that's precisely it. Like, you can't stop here. If you stop here, you're not going to do that well, right?
Yeah.
Now, I would make it a little, because I agree, the case is hard to make.
Yeah.
You know, we're using here the headline. We're not using the underline, right?
Yeah.
So that's going to be an important point. Let's just remember that. We're going to come back to that a bit later when we start to maybe argue maybe it's not as effective as we think, right?
Sometimes I call it willful ignorance. Like
the headline?
Yeah, well, just any usage of statistics ever. Like, you can almost just pretend that
show whatever you want.
Yeah, show
right?
whatever you want.
That's it. And that's a good lesson here. So, okay, we kicked it off, right? On the face of it, we're in the target, right? Finally, it's the lowest inflation we've had since, you know, end of 2021, you know, peak sort of COVID inflation period. So on the face of it, you could say, great, right? Like, monetary policy, you know, we've obviously had these 13 consecutive increases, right? It's working, right? So I think that's the first argument that you could make. I think the second sort of supporting argument connected to this is that, you know, if you want to look at, you know, obviously the CPI measures a basket of goods. If you look at the majority of goods within that basket, right? So 61% to be precise, of those goods rose less than 3%. So this is where, you know, we're trying to look at, okay, because obviously headline is going to take into account one-off factors. It's not necessarily going to give you a better long-term indicator. But if you look at the trend data shows certainly quite significantly over the course of 2023 and 2024 that the percentage of goods in the CPI basket are now increasing at slower rates, under 3. Now, just to compare that, at the end, the final quarter, you know, the December quarter of 2023, only 15%, right, of goods in that CPI basket were under 3% price increases, right? So 61%, that's a big shift this year, which I think is exactly what you could say, right? Is why, well, okay, you know, inflation's coming under control thanks to monetary.
Yeah, there's a lot that, I mean, I'm sure Rowan has a lot as well. There's a lot I want to say about that, but probably for the best.
Let's keep that for the other side, all right?
Yeah.
Let's keep building the positive case here, Terry. I know that's hard to do, but let's do it, right? So let's jump into the next one. What's the next argument we can make about why?
Well, yeah, as we said, we've got that dual mandate. So if on one hand the price stability side of things is looking pretty good, we could also say that on the labour market side, the full employment side, it's actually looking pretty good. Now, I find this one probably the lesser strong of the cases, simply because unemployment and full employment numbers have generally been pretty strong and pretty resilient throughout this whole entire period. So I think one thing which maybe you guys can start to think about is if the numbers are good but they haven't changed very much, right? So if they've been fairly stable, does that mean the policy hasn't been working? Has it had a fairly limited response? I don't know. But to give you guys just some numbers to play with, we've got for November, we've got 4% unemployment. We've got participation still hovering at those really high,
record
high numbers of 67%. Underemployment at 6.2%, which is fallen since COVID. And so if you look at this on face value, it looks like a very positive outcome.
Again, another tick, right? Hey, great. And I would argue this, I'd probably say that there's something you could add to even say more than a tick here. Now, I know we're going to unpack some stuff later, but, you know, I think the RBA acknowledged when they made this contractionary shift in policy that they had an expectation that they were quite okay with unemployment moving up to 4.5%, right? So they had actually said, look, you know, we anticipate the trade-off here, right, is that we're going to slow the economy down, and, you know, inevitably we're going to see some trade-off. Unemployment's going to grow, but if it stays at 4.5%, like, that's still us meeting our dual mandate. You know, we're still keeping unemployment relatively low, certainly at historically low levels, right? And we're getting inflation under control. So I think you could even argue here a lot more strongly to say, well, the fact that unemployment's gone the other way, it hasn't gone up. It's actually like, you know, it's gone up a little bit, but it's come back down and it stayed around that 4% even, is maybe a testament to exactly how effective it has been. Now, again, you can argue maybe this has got nothing to do with monetary policy, right? And we will when we get to the other side. But on the face of it, I think you could certainly say, well, they expected 4.5% potentially. We're at 4%. That's like a double tick, right?
Yeah, and I want to just jump in quickly. Like in the context, if I'm marking this as an essay, I'm not expecting people to whip out, you know, full report word like stuff. like stuff that is from a full-on detailed report done by a certain government think tank or whatever. Like, if someone were to make these points, I would just go, yeah, that's lovely. That's great analysis.
Yeah. So let's keep building the case, right? For why we think, or why you could argue, right, that monetary policy has had some effectiveness, right, and been effective in 2024. So the next one, Terry, what do we got?
Oh my God. Yeah, so I'm just barely holding it together right now. But economic growth is still positive, and we're not in a recession, Ron. So I guess to go to that kind of third goal that the RBA has, the economic prosperity and welfare of the people, eco growth has been at about 1.5%. Now, very interesting, because even the target of economic growth has been something that's been subject of debate. So if you open up any kind of textbook, you might see stuff like 3 to 4%. I've seen 4.5%.
I don't know when that's been the real target for, like, I don't know, like a decade, 15 years ago. I don't know.
Pretty odd. So like, I think the notion that it's below target is dubious in itself, because who knows what the target is these days. But it's not negative, okay? Yeah. And I think most people will generally agree that a non-negative economic growth rate is something to be happy about.
And I think, again, particularly on the basis of such an aggressive speed at which the cash rate was increased, you know, like, I think that's probably, you know, the sort of qualifying factor here as well, because certainly 1.5% is pretty anemic, right? And we'll certainly unpack that a little more. Yeah. But I think, you know, like, it could easily be worse, right? So, you know, okay, like, you know, I think most advanced economies tend to grow at 2%, you know, in the low 2s, right? So my argument, if you're trying to say that monetary policy is effective here, is despite a very contractionary, you know, sort of stance in a quick period of time, you've got economic growth not far off what advanced economies sort of tend to average.
Yeah, I'm not going to say that. I can't say that. I'll leave that one to you.
Perfect. Now, I think that the next thing is, I think where this goes to Terry, your question earlier about how can you tell if a policy is contractionary, if, you know, for example, like, we've had no change in the cash rate all year, right? Yet we can still say,
we feel it.
Yeah, right. Oh, this is contractionary, right? And so there is a concept called the neutral interest rate. Now, Terry, how would you describe that if you had to sort of explain that?
Yeah, so I'm going to be honest, this is the first time I've come across it.
Okay.
So if I'm going to speak off the top of my head, a neutral interest
rate. Yeah, if you had to try to, like, unpack it.
For me, I think so I would almost say that the dichotomy between contractionary and expansionary feels a little binary, right? So something you mentioned right at the start today was that it's not all just black and white.
Yeah.
There's actually little grey areas. So my idea is maybe there's this Goldilocks zone in between where you start to go heavily expansionary and heavily contractionary, and there's actually this big, fairly large middle section where actually you're potentially doing a little bit of both, where they cancel each other out. And so then the issue becomes which sectors are being expanded and which sectors are being contracted. But overall, big picture speaking, you're kind of neutral overall, net zero, a net zero cash rate, if you will.
And I think that's exactly it. I think that what's great about it is, you know, and that's what I love about economics, is that a lot of the time you can sort of work out, like, from like a first principles approach of, like, okay, what might this sort of mean, right? And I think that's exactly it. So the neutral rate highlights this idea that, you know, typically, right, when, you know, in cash rate's low enough, you'd assume it's going to be expansionary. When it's high enough, it's going to be contractionary. And you've hit the nail on the head. There is a point, right, where it's going to be neither contractionary or expansionary. It's at a point in the economy where it's having neither of that impact, right? So it is a long-run concept, right? And basically it's this idea, right, because there's a couple of ways we can define it, right, where it's the point at which growth stays at trend and inflation remains constant at target. So, in other words, you know, it's just keeping the economy as it is, right? So if growth's at 2% and inflation's at 3, right, and the cash rate is at a level that just maintains it at that level, it's considered to be neutral because it's not actually growing or shrinking the economy. Now, where am I going with all of this, right? There's a point in all of this, in that what you want to do then is to understand the actual impact of the cash rate on the economy. What you want to actually do is back out the nominal neutral interest rate, because that's the, you know, the rate. So let's say, you know, for argument's sake, right, and we've got some data here that we'll share in a moment that the RBA provides, right? There's this general idea that, let's say if the cash rate's, 4.35%, possibly the neutral rate is 2.5. So actually then, if the economy, anything greater than 2.5, right, would therefore then be contractionary, right? Where if it was less than 2.5, and that 2.5 is a number I've made up for the point of this example,
okay,
right? Just to be clear, I don't want anyone writing that in their essays and then...
Hey, yeah. I would believe it, okay?
But then if it's below 2.5, right, well then that's the point where you go, oh, okay, this must be expansionary in nature. So the reason I think we can utilise this then to evaluate a policy, and this is particularly coming back to the global perspective, right, is that if we look at where our actual sort of rate is at the moment, right, in terms of estimates, it's called an estimate of policy restrictiveness. So it's the degree to which the cash rate's actually having a contractionary impact once we've got rid of the sort of nominal neutral, right? When we look at that, okay, Australia's actual, even though, it's 4.35, right, that is at a similar level to Sweden. It's lower than Canada's, it's lower than the Euro, it's lower than the UK, it's well lower than the United States, it's lower than Norway, it's, again, considerably much lower than New Zealand, right? And so they've got the restrictiveness that's somewhere around about, it's a little bit less than 1%, right, in terms of impact on. So that tells you, actually, for Australia, our, nominal, the neutral rate is probably somewhere around the low threes, right? In terms of anything above 3 is probably contractionary, anything below 3 is probably expansion. Now, how can you utilize this? I think the point is just to highlight, we're sort of criticizing, you can criticize potentially monetary policy's effectiveness on achieving the objectives, but when we actually compare it with the rest of, the world, we've been arguably able to achieve these outcomes with a level of policy restrictiveness that is less than pretty much all the countries I just named.
Yeah.
Right?
Yeah. So Ron, just to kind of consolidate what you've said, because I think there might be some viewers
some
that want
confusion,
some clarification.
possibly. Yeah.
Are you saying that you would prefer an economy to have a lower level of policy restrictiveness?
Well, I think this speaks to how contractionary we're trying to say our policy is.
Okay.
Right, and so I think on the face of it, we're all saying 13 increases. This is relatively contractionary, right? And I think the RBA is certainly trying to argue here, because I think some of the argument could be, we haven't raised it, but some of the argument could be the RBA went too slow and not hard enough, right? Because inflation's been sticky, right? And that's something that we'll certainly maybe say in a moment when we get to the case against, right? I think the RBA's perspective would be, well, hey, wait a minute, if we look at policy restrictiveness, right? Actually, yes, we have been less restrictive. So everyone's complaining to no end that the cash rate is too high and we need to lower the interest rates. But wait a minute, everyone else went harder and they did it more, right? We've been less than everyone, right? So if we reduce it now, right, we might not actually deal with the issues to the extent that we think, right? So that's, I think, the point, right?
Okay.
Yeah.
So I think just to
to tighten it up,
just in terms of what the viewers can use, I think what you're saying is in the context of contractionary policy,
yes,
you would argue that a lower level of restrictiveness gives you more room to operate.
I think one, it does that, yes, for sure, and I think secondly, it probably highlights that Australia's arguably been able to do more with less.
Do more with less,
right? In the sense that they've less restrictiveness. And, on the face of it, as we've highlighted, inflation tick, economic growth tick, unemployment tick, right? So I think that's sort of how I would sort of tie it together.
Yeah. Look, I have a few more thoughts about that, but I think we might...
We're going to get to... we can tear it apart in a moment, Terry.
Yeah.
The final thing, I think, just to highlight as well, which is, I think, an interesting point, because I think, one of the ways you can compare effectiveness is to compare it, as I said at the start of today, and we were both unpacking, Terry, to what the globe's doing, right? And I think there are some things that are quite different about Australia and why the RBA has had to adopt the policy approach that it has. And some of this you could actually, and this is a nice segue into arguing the other side.
Absolutely.
Because I think some of this you could actually use to argue the opposite point, right, that I'm about to try to make. Which is that, one, other countries had to go harder and quicker than the RBA because they had a much smaller percentage of people on fixed mortgages, i.e., Australia has a much smaller percentage of people on fixed mortgages. So in a country where, like for example, the US has 88.7% of the mortgage holders are on a fixed mortgage, i.e. they've locked in a low interest rate, right, on that mortgage. Therefore, increases in the US, Fed Reserve rate, right, is only going to impact an even smaller percentage of mortgage holders, right? In that case, 12%, and then those when their fixed contracts roll over, right? So it takes longer, in other words, for the transmission mechanism in some ways to sort of work for those interest rate decisions to pass through the economy. Australia, we only have 11.8% of mortgage holders on fixed rates. So in other words, everyone else, 90% almost of people are on variables. As soon as the RBA changes the cash rate, the banks then change the interest rates, right? It flows straight on immediately. And so the speed sort of to market of impact is actually much quicker. And so that alongside, the fact that Australia's got, over 100%, almost 110% household debt ratios, which is way higher than pretty much most of the OECD. And that's because of our crazy property prices, right? I think both of those factors, also go to explain, and you can argue, hey, this is why the RBA went slower. It's why the RBA didn't go as hard, right, than everyone else, because of specific factors to the Australian market, right?
Yeah. So my thoughts on that. First of all, I saw this on Reddit the other day. It's very
cool.
Interesting. Yeah. So the exact same graph. What I would say from that I find very interesting then is if you were to go back to policy, right? There's often this narrative with Australia that they are very opportunistic, in the sense that we were opportunistic during the GFC, during mining booms, and now potentially in that post-COVID period as well. So to kind of say something nice about the case for why the RBA has done well, because I think I've been a little bit not too nice today. I think what you could then make the argument for, as Rowan highlighted, was perhaps the intimate knowledge of all those things that Rowan's just gone through in terms of the policy restrictiveness, in terms of the nature of our home loan market and our mortgage structure, as well as our high levels of household debt, that they've used all those unique, as you said, they're very unique conditions to do with the way that the Australian economy is structured. And then they had that knowledge of that and they had the foresight to go, well, this is now what we need to do. Yeah. And I think that could be a very, very solid argument, because what I don't really want to see from a teacher's point of view is you guys just kind of throwing stats in there, but not connecting it really much so to a strong argument. Because I think, as Rowan and I, we're both economics students. We love to see graphs, we love numbers, but at the end of the day, I think for a marker who's just going through this stuff, they'd probably just give it to me. What do you want to say with this? Yeah. So make sure you just kind of make that connection in the end.
Yeah, you got to make a point, I think, isn't it? You can't just drop the number in.
Yeah. Oh, yeah.
And then move on.
Yeah, 100%.
Which happens a lot. Yeah. So, I think we've now made probably as compelling case as we can, for why monetary has been effective. And I think the point in all of this is, even if clearly, as we've been sharing some of this, there's been that little voice inside of you screaming out saying, but no, the point here is that a good essay is going to highlight both sides of this, right? They're going to highlight, well, on the one side, we can see it's done this. However, right, there's, some other considerations, right, that we're going to bring up. That, however, can be a magic word when used effectively.
It's a beautiful word.
Yeah, let's start unpacking. I know Terry is very keen for this, so I'm going to let Terry lead off, right?
Yeah. So
what is the first thing that we can maybe raise for why monetary policy not as effective as?
So I think it's probably best for us just to kind of go back through the way that we did the case 4. So we might start with the inflation case, right? So the first and foremost thing is very basic kind of stuff that you guys look at in your course, which is that the RBA's monetary policy, generally speaking, through the transmission mechanism, affects what's known as demand pull inflation. I remember in 2022, the RBA published a paper themselves which said that somewhere between 70 to 75% of the current inflation that they were facing at that time were from, cost-driven factors. So things like the price of oil, the price of shipping, and things of that nature. So there's a case being made here, which is that no matter if you're dealing with, and to keep it simple, if you're dealing with two completely different types of inflation, and the policy is designed to specifically target demand-driven inflation and not cost-push, which is what the majority of inflationary factors are, the first question I think every student needs to be asking is, well, to what degree has this been a success then? So how can something that was designed to deal with something else take credit for perhaps inflation just falling in terms of, oil prices stabilizing, or transportation and logistics kind of sorting themselves out. So that'd be the first thing I'd look at.
Yeah, and I think what's interesting, right, is that I think the RBA has probably presented a slightly different narrative, right, around the causes. I mean, I think certainly they've acknowledged, as you highlighted, that clearly some disruptions to supply caused by the pandemic and the sort of after effects of that. I think there's certainly been a narrative that keeps coming through around concerns around excess demand. And that makes sense because, again, the policy it's well suited, it's demand side, right? So there has been, I think, a sense of saying, no, there's excess demand for goods and services because, there's all of that, that extra cash that's been floating around that no one spent during COVID. It's all, bank accounts, right? The mortgages are all, they've got buffers, etc., right? And there was, I think, a concern, not just that, okay, we've got some supply side inflation, but that excess cash, right, would then start driving demand pull inflation in the economy. And so it was, I think, a bit of how do we also stamp down on that, right? I think the challenge has been certainly, and I know, an institute in the US has looked at, a whole lot of data, the Brookings Institute, and they basically said, from now, in the benefit of hindsight, right, looking at this data now that we've got better access to it over the last couple of years, basically the vast majority of the inflation surge, certainly, the US economy, sort of Western economies, right, was a result of an inflation surge from supply-linked factors. So in other words, you could sort of argue, well, wait a minute, the inflation that we're seeing here is probably more driven by supply side than demand pull, and therefore, is monetary just inflicting unnecessary pain, right, on the Australian economy and Australian households, and not really having much of an impact, on inflation. That inflation figure that's falling, it's for other reasons.
The other thing I'll just quickly tap on with that, with when you said that there was a prediction that there'd be this kind of pent-up demand and demand-driven inflation, is that the issue with monetary policy is also very blunt, and that unfortunately there's no consideration of the fact that where is a lot of these savings coming from. So one group that has had a little bit of attention spotlighted on them is this idea of the retirees,
yes,
the people who've already paid off their home loan. So just to clarify for you guys, if you own your home outright, essentially all this narrative surrounding things like mortgage repayments and interest rates has no impact on you because you own your house. You don't owe the bank anything, so you don't make any loan repayments, and so essentially, or you don't engage very little with what the market interest rates are. And so even if you're the one that's been driving so much of that spending, because guess what, you own a house in Australia, right, and you're retired and you've got plenty of beautiful goods and services to go and spend your money on, and by all means go for it. But the problem is then that what happens with monetary policy is the pain being inflicted to deal with a problem that was never going to be solved with that in the first place.
Yeah, and I think this highlights, the fact that only about a third of the Australian population are mortgage holders, right? So what we're sort of speaking to here then is we've got a policy lever, a monetary policy that's been pulled that's squeezing a third of the population rather than the entirety. And then to Terry's point, it's squeezing a third of the population that maybe don't have that excess cash that everyone thinks. It's, the retirees, the people that are already, owners mortgage-free of a property. And so actually the irony is increased cash rates benefit them because they're usually net savers. And so they're actually generating greater income, which may then lead to further consumption, right? And inflation. So what we start to see here, I think, is limitations in the transmission mechanism, right? Because in theory, the transmission mechanism, okay, yes, right? We change the cost of credit, right? We change, the cost of existing borrowings, and it, in theory, we think of this having an even distribution effect on the economy, and that's not true, right? And we can sort of see that, and so we see mortgage repayments are at record highs. They're much, they're higher now than they were, during sort of the 2008 housing boom, right, and bubble that occurred just pre-GFC, and if we look at cost of living, the increase in mortgage costs, literally just the increase in them, not the whole, just what's changed, has contributed to about a third of the cost of living increase in the past 3 years. So you can sort of see that it's really hitting a small group, a third of the economy, very, very hard, right, who may not be the third of the economy we need to hit in the first place, if there is any excess demand, right? And it might not even be about excess demand, because most of the data is indicating that it's still supply. So there's a lot you could say here. I think.
Yeah. I may have jumped the gun a little bit.
No, but I think that, it's a good connection. So
yeah, maybe we go back a little bit. Yeah.
We'll jump back. So let's come back to inflation. So I think, there's still some stuff we can still say even further about inflation. I think that's us questioning the type of inflation before you even look at the inflation data itself, right? Let's jump in and sort of question that, because I know we talked about headline last time, right? What if we take a different data point, Terry?
Yeah, so when you look at the underlying inflation, which just kind of discounts some of those one-off factors, and I think the clearest one-off factor that we've had is we've had government rebates in terms of the energy prices.
Yeah.
When you get rid of that, and so we're using here the trimmed mean, which the RBA calculates, we're actually still above the 3% target range. So we're
quite well above, aren't we?
Yeah, we're at 3.5% still. And so while on one hand we said that, like when you look at the headline inflation rate, things are looking good. When you look at the underlying one, it's actually not so good.
Yeah. It's coming down, but it's coming down very slowly. Like, it is very, very sticky, which implies that when we look at a couple of other things in a moment as well, that it's not excess demand that's the problem, because we're going to look at some data points that indicate, consumption and other things like that are pretty flat, right? So if it's staying so sticky, it suggests, there's other stuff, right, that's maybe supply side that's still causing that to occur. I think what's interesting, I think this goes to this question about, who takes credit for what, right? And, look, the government, and the budget will take credit for a lot that monetary will do. And monetary will happily, take credit at times for work that the budget might do. And I think this is a good example here, because if we look at the rebates, right, that occurred, right, like government rebates basically, meant that electricity prices would have fallen without them about 2.7%. It would have fallen a little bit. With the rebates, right, 15.8%. Okay, now, the interesting thing here, right, is that if you looked at the headline, right, and you backed out the rebates, it would have taken, that figure up to 3.2%, right? So again, it's either way showing that the rebates, in other words, fiscal policy, both at a state and federal level, is probably playing a bigger role right now in driving some of that inflationary pressure down than arguably monetary policy is. So this goes to the macro policy mix, which is one of the things that you can reference when you're evaluating the effectiveness of policy. And so you've got an argument here to say, maybe it's fiscal actually here and not monetary. Anything to add, or what's the next sort of thing that we can use here, Terry?
Yeah, so if we're going to go down that route of looking at specific items within what makes up that CPI basket, I think it makes a lot of sense to just look at household consumption. And this has been something which has already been well documented over the past year, which is that household consumption has just been completely flatlining. So some stats here, the volume of retail trade has actually fallen 0.6%, which... Yeah, and I was going to get to this at some point as well. Like, when you look at the fact that, I know earlier we spoke about growth being 1.5%, that's positive.
Yeah.
But when you start to account for what's called the per capita basis, so basically when you look at what percentage the population has grown at. Now, do you have the exact number? Because I know normally we'll do between about 2% a year.
In terms of population growth?
Yeah.
I don't know I know what the per capita GDP is, but I don't know what the...
Here's shout out geography here.
Yeah.
So it's listen in geo, guys. It's usually about 2%. We're one of the fastest growing populations in the world.
And I suspect it's more this year though.
Probably,
probably because of the just, bounce back after COVID.
Probably 2.5. So the fact that the GDP growth has been lower than our population growth basically means we're in what's called a per capita recession. So on a per person average basis, we actually have a lower GDP. Yeah. So this speaks to, again, with the household consumption side. So yeah, we've fallen, but then when you factor in that population's actually grown to 2 to 2.5% in that time, it's really bad.
Yeah.
And so I think that paints I think what that does for me as well is it paints the picture of what cost of living is. So I just want to give a quick little mention here of cost of living. When we sit here and we analyze statistics of inflation numbers, that looks at prices. But at the end of the day, I think even when inflation slows in a process known as disinflation, as you guys will know, The issue is that it doesn't then reverse the pain that people have been going through. Their cost of living has still been high. And in fact, even if inflation slows, it doesn't take away, like cost of living doesn't suddenly improve unless wages kicks up, which it has been okay, but not great.
But slowing as well. Yeah. I think, I think what it highlights is, like if you factor in, the population growth, we're sort of buying it's actually retail trade's gone backwards by about 3%, negative 3% on a per capita, which is interesting because 0.6% is what it fell. If you're saying it's probably sitting close to 2.5%, we're getting close to those numbers, right? Which make a lot of sense. So I think what it shows, and you can sort of see even in September, household consumption was 0% for the quarter, right? Like it basically was not really shifting. And so I think what it shows is it doesn't look like excess demand is going on here, right? Like despite all of the contractionary monetary policy, right? Like we haven't really seen excess demand break out, in retail spending and household consumption that, is exactly the thing that monetary policy should be clamping down on to deal with, which does indicate that we're still seeing that sticky inflation being driven by more supply side factors, which make it very hard for monetary policy to address. What about economic growth? Because you started touching upon it, right? Yeah. In terms of GDP per capita, I think we should unpack that a little bit more because I think there's a lot to say here as well. Where do we go in terms of evaluating monetary here?
Here we go. So lowest point since the 1991-92 recession. So most of the viewers weren't alive.
Excluding, we should say excluding
COVID.
Excluding
COVID. And so, as we said earlier, the entire economy grew just 1.5%. As Ron said, it's the worst result since 1991-92, excluding COVID. Yeah. And then we mentioned that population growth is usually around 2% this year, probably closer to 2.5%. And so, if you were to just do very basic numbers, that 1.5 is lower than 2 to 2.5, which just means that yes, we've grown the population a significant amount, but even with this additional kind of labour force, we haven't been able to produce more than what we've added in terms of population. So on a per person basis, we're less prosperous.
Yeah, and it's quite significant. Like if you look at it, it's also getting worse. I think that, if we look at June last year, right, we were at a per capita recession. We weren't yet, but we had our first quarter of negative per capita growth, right? So it was minus 0.5%. December it was minus 1%. March it was minus 1.3%. Now September this year, so year and a bit later, it's now minus 1.5%. So
we've been asleep at the wheel because I think there hasn't been too much notice to this. I think when we did have that last year, right, in that kind of June, September quarter, there was little murmurs of it, but it hasn't really kind of picked up.
It's been sitting under the radar,
right?
And so I think the reality is we're in a GDP per capita recession. It's getting worse, right? And so if you were to evaluate, monetary policy's effectiveness, right, you could be really saying, well, look, there's certainly a pretty big conflict here in the objectives because yes, they're trying to get inflation down, and sure, one of the ways you might get inflation down is by slowing growth. Okay, acknowledged. But it feels like it's sort of starting to run away, right? Which is certainly a concern. Now, note what I think is interesting is why are we then, if we're in a per capita recession, what's the thing that's been keeping, us, just our overall GDP in the positive? Because we said, the irony is, right, it's a 1%, it's 1.5%, right, growth if we don't look at it at a per capita basis. So what's going on, Terry, and is it monetary policy or is it something else?
Yeah, so a quick reminder of, I think it's a good way to segue in some echo theory, right, is that when you're looking at that aggregate demand function, when you're looking at growth, it has to come from one of these. So it has to come from consumption, from households, which we just discussed was terrible. It can come from business investment, which the less said about that, probably the better. I've always been a big skeptic, unfortunately, since I started this course. Business investment has always been, every time I see some politician come out and say, oh yeah, we're going to do great with business investment, I always just kind of side-eye that one. So that hasn't been great.
I think the last time it was great was probably mining boom, right? In terms of investment, right?
I was just in school. Then you've got net exports, which has slowed down,
and it's going to continue to, I think. Yeah.
And that basically means the other one, which we haven't talked about, is government spending.
Yeah.
So, government
And
spending.
where does that? Well, that's fiscal policy. Here we go. So I think yeah, exactly. You're right on the money, Terry. Right? Like if we look at it, right, and we can sort of see the basic premise, right, is that fiscal policy, government expenditure, is really contributing a significant component, right, to the economic growth in each quarter. It's making really the driving impact. And so what's interesting is over the past 44 years, right, when GDP has remained flat, right, unemployment usually rises by 1.1%. Okay, so when when GDP is not really growing, you just get a slow uptick in unemployment. Now, the argument therefore is that usually is about 100,000 people in Australia. So the fact that we haven't seen that occur with, because GDP is not flat, we've had a bit of growth, right? But that growth has come from somewhere, the government, fiscal policy, right? What you can sort of argue here, therefore, is one, fiscal policy is probably the thing that's keeping keeping the economy just above, right? The sort of technical recession, right? In terms of 2 quarters of negative growth, because I think the last quarter was like 0.3, right? So we're not far above, right? That figure. We're getting closer and closer to the zero. And the argument, therefore, you could make is that also the reason our unemployment level is as low as it is, right? 4%, it hasn't really budged, isn't because monetary policy somehow managed to get this balance right, but it's because fiscal has come to the party, right? And has, as a result, prevented 100,000 people from being unemployed, right, over the last year. Is there anything you want to add to that?
So for me, like I'm probably a little. I don't know if we go into it later, but I'm a little bit more skeptical about relatively strong unemployment numbers, because I almost look at that and go, well, with enough time, to what degree does a low unemployment rate, rather than just being a sign of a strong economy, be more so a symptom of a weak one, in the sense that people are feeling obligated almost to step into the labour market. So my thing that I've spent a lot of time looking at this year is actually just how the underemployment calculation is done. And so just to, without boring you through the details, the RBA does publish stuff on this as well. Essentially, it relies on people's expectations of how much work they're willing to get and how much they can get. The issue here is that if people are living in an economy essentially where they feel the pinch, as we've spoken about the cost of living crisis going up, it almost feels like a low unemployment rate coexisting with a relatively a decent unemployment rate might not be as good as you might think when you look at it in the context of what everything else is with cost of living. It almost just feels like people are going to, like it's zombie land, people are going to work because they have no other alternative. So I'm actually probably a little bit more on the skeptic side. Not to take credit away from the government, I do agree with you. I think the government has been fantastic.
I think either way we can sort of say, though, with that analysis, which I think is really great, is that it's probably not the RBA getting some sort of policy setting right?
Boo the RBA. Like,
it's probably, the cost of living biting, forcing people to get into the labour force, right? Which is driving the participation rate, you would argue, right? For sure. I think that's a good point. Yeah. I would also probably go to say, right, that I think the RBA's forecasts have been so off for economic growth, right? And not even like, I get that forecasts are like staring at a crystal ball, right? Most economists don't get them right? But I think what's interesting is the RBA estimated annual GDP growth would go from 1 to 1.5% in December. Now, this was a very recent estimate, right? So this wasn't done, like all that long ago, okay? What's happened though is we had a 0.8%, drop, so economic growth fell, so it wasn't 0.3, it was 0.8%, right? In the September quarter. So in other words, it's meant to go to 1.5 by December, but it's gone from 1 to 0.8, right? Yeah. So it's sort of going the wrong way, right? Which also makes me think, hey, wait a minute, yes, like the RBA, this is not part of the RBA's plan.
I just had a very intrusive thought right now, which is that we've spoken many times about the RBA's jawboning, and in terms of that strictly is often to do with their stance of monetary policy. Yeah. But what if nowadays their jawboning now extends also to their predictions? Wouldn't that be something?
I mean, it could, right?
That they are predicting, as the kids would say, predicting their manifestations. They want to manifest a 1.5% economic growth in December,
But hey, they're waiting for the Christmas miracle. Yeah.
Oh my god.
So I think let's keep moving, because there's probably, I think, probably two more things, right, that we can sort of really highlight here that we haven't already unpacked. And you can see this is like obviously a very nuanced approach, therefore, to how you could. And obviously this level of depth, you're probably only going to touch upon certainly, it would be a monetary policy focused essay only. Like, if you're trying to do this with fiscal as well, some of what we've talked about is obviously very relevant, but just be mindful of that. I think the other thing that I've found really interesting that like you've been looking at the unemployment, I've been looking at it from a different perspective. I've been really interested in how a lot of the RBA's policy setting is contingent upon their consideration of what the NAIRU is, right? Yeah. Because at the end of the day, right, just as a quick refresher for those of you that maybe haven't even done the NAIRU yet, depending on the sequence that you take, right? The NAIRU, non-accelerating inflation rate of unemployment, is the point at which there is meant to be no cyclical unemployment in an economy. So therefore, if you get further increases in economic growth, the premise is therefore that you can't see decreases in unemployment because there's no cyclical to decrease. And so you get upward pressure on inflation, I should say, and that can happen quite quickly. So what I think is interesting is that, the RBA's been quite concerned, I think, of that excess demand. They keep talking about it. There's been concerns, in the past, the RBA had raised some concerns about the possibility of like wage breakouts, right, and that impacting ongoing inflationary pressure. And so, one of the things they've sort of kept on highlighting, right, is the fact that they say explicitly that the level of demand they still think is higher than the level of supply, right, which is why they're not reducing the cash rate, right, otherwise they would have. And they look at the labour market as one of those factors, okay, and so at the moment, right, if like we assume, that unemployment right now is 4%, right? If you assume that is above the NAIRU, right? So, I should say below the NAIRU, which is the whole point, right? Yeah, below the NAIRU. So let's assume that the NAIRU is 4.25 or 4.5. I could understand the RBA's perspective, right? Because you'd be quite worried, well, if we keep seeing economic growth here, we're not going to see any further reductions really in unemployment, we're just going to see increasing inflationary pressure. And so the argument that's sort of, I think, being raised is that there's a suggestion that the RBA has got the NAIRU wrong, right? And they're operating on this assumption that the NAIRU is over 4, right? And in the past, right, Treasury certainly had sort of indicated that, it's probably around 4.25%. So you could therefore understand, if Treasury, the RBA's data is saying 4.25, right, and unemployment's below that, they're like, we're below the NAIRU, right, we're going to risk that excess demand and inflation. Now, I think the challenge, though, on the flip side here, right, is that, actually a whole bunch of economists, right, sort of suggest that they think the NAIRU is a lot lower. They think it's 3.75. So in fact, we're above the NAIRU. And part of the argument for that is that, unemployment seems to keep on finding a way to decrease, right? Terry has some reasons as to maybe why. And the participation rate's growing, right? So it shows that there's actually excess supply still available in the labour market. We're not at a point where there is no more capacity. So just to tie that together, because I want your thoughts on this, Terry, I think the point here, therefore, is that you could be sort of criticising the sort of policy stance and its effectiveness to be saying, actually, the RBA is sort of founding a lot of this policy response on a NAIRU figure that's likely wrong, and therefore, they're sort of taking the wrong insight from the labour market. There is no excess demand happening here, and as a result, the policy setting's off. What's your thoughts on all of this? Because I know you've clearly been paying attention to the labour market in other ways as well.
Yeah. So, I first thing I just want to say is I feel like that character in a movie that like predicted something, and then everyone doesn't believe him, and he thinks he's crazy, and now he's like finally right. Look, I would say like I've thought about this for a number of years now. I've always looked at the NAIRU figure as
I remember you've mentioned it. Yeah, in prior videos. Yeah,
I've looked at so go find those ones. Yeah. Link them below. I've always approached it with a healthy level of skepticism, and simply because I think when you look at data over a long enough period of time, when things don't behave the way that they do based on your expectations of economic modelling and theory, then it has to mean that the model itself needs to be looked at again. So I've always thought that from my point of view, it's very simple. It's just that looking at the unemployment rate itself is probably not enough. I think when if it is something that's concerned with this idea of spare capacity, why are we only looking at unemployment? We should be looking at underemployment. We should be looking at the average monthly hours worked. We should be looking at like a wide range of things. And so I think my issue isn't with having an IRU. I think it's very useful, but my only concern is that I think it needs to just be a bit more comprehensive in terms of what it looks at, because as Rowan has highlighted here, they make very important decisions using this information, and to their credit, and I know what we're doing now is we're going back and giving the IBA a bit of credit here. To their credit, they are very consistent. They're consistent in the sense that based on what their data is telling them, they will act with the best interests of the Australian people in mind. I truly believe that. However, the problem becomes when you've got such a large team, and I've been there, I've been to the IBA, but like they've got a very lovely team. The problem, though, however, comes when perhaps the data that you're using or the models you're using do not reflect reality. And I think the departure from that occurred because fundamentally the labour market that we see now in 2024 is not the same labour market of maybe even just 10 years ago. Yeah.
There's been a lot of change for sure. Yeah, I agree. So look, final point we can make in what has become, I think, a pretty deep dive, to be honest, right?
Probably the deepest we've ever gone.
And probably the deepest you're probably going to find anywhere on the internet. I would probably say on Australia's monetary policy.
Well, that's it, because there's no...
Who else is talking about this stuff at this level?
Nobody cares about Australia apart from us.
I think the final other thing, and this goes to the RBA's dual mandate, right, around like unemployment and the fact that it's so low, and we said, in the case for... right, that it's so low, it must be, it's doing an okay job, right? I think there's something that's, it's starting to take a lot more, and again, this is definitely sort of, in more recent years, and understanding that we can't just look at, GDP to determine a recession. That was the point you made earlier. We need to look at per capita. One of the other things is there's something called Psalms rule, right? And this basically was created by, a US economist that basically has predicted 9 out of the last US recessions, okay? So the principle basically is that we can look at unemployment data to get a sense of like predictively when we're going to hit a recession, right? And this makes sense because, there's lagging and leading indicators, right? There's time delays, and so we want to look at things that, almost like the canary in the coal mine that tell us something's going to happen. And so the basic premise here, right, without going into like the crazy nitty gritty, is that if you've got like the current rate of unemployment that is 0.5 percentage points higher than the lowest point in the previous year, okay, it means that you're in the early stages of a recession. That's what the Psalms rule says, okay? So the point here is that, according to this rule, Australia hit that. They hit the 0.5, right? We hit it, so we're arguably already in the early stages of a recession, at least for a month of this year, right? Because the unemployment then sort of, changed a little. Now, the RBA disagrees with this. They say, well, that's 0.5 is the US market. We want to localize it, right? And if we localize it, their argument is 0.75%, right? Which then we've got a bit of wiggle room to go, right? And so we're not there. So, of course, I think the argument here really turns on what data are you using, right, in terms of the threshold. But I think, again, it probably speaks to this question about maybe, again, the labour market, to your point, Terry, isn't as strong, right, as we think, right? And therefore, that speaks to the effectiveness of monetary policy. Do you have more that you want to add here as well, Terry?
Yeah, well, but when I just saw, I remember looking at the Psalms rule all the way back in university, so I haven't engaged with it since then. So I found my only point was, to what extent can you apply this to the Australian context? And you basically hit it out the park, and you had that. So
yeah. Now, the final comment then that I would just sort of share, the other thing that you can sometimes use, and this speaks again to who's doing the lifting between macro, fiscal and monetary, right? And I think that's one of the things when you're evaluating each of the policies or even the macro mix is to sometimes you have to tease the threads out, right? In which one's doing what. So I think the final thing that we can sort of consider here as well in terms of pulling out the threads of, is it fiscal or monetary doing the work here? Because I think often when you're evaluating macro policy, you do need to do that. Is that the market, if we look at the market sector, so i.e. non-government sector, okay, the number of hours worked, right, have basically not budged. So in other words, the market sector is running very, very flat. So if we're looking at, the fact of what's contributing to employment in Australia at the moment, a lot of that is government, right? It's NDIS, right? It's like government infrastructure projects. And so the government stepped in with hiring, right? And that's in some ways what's also supporting this sort of low levels of unemployment, right? So again, it's fiscal rather than monetary, right? That's maybe supporting some of the outcomes that we're seeing in the labour market. So there you have it. That, I think, crazy deep dive. Hopefully you've got a good framework though in how to think about, like, to evaluate monetary, because this data will all change, right? As 2025 unrolls, right, the monetary policy settings might change, and the impacts, the stats will change. But hopefully what we've given you is, oh yeah, there are these things that I should be looking at and thinking about, right? That I can apply for why I might say it's good, but why I might be able to argue that it's not also as effective. There's anything that you want to add before we wrap this?
Yeah, so I just think everything Rowan just said, on top of that, I think the importance here is that you really, and I've been trying to do this throughout the video, is just to try to connect it to some of the other things which you might more familiarly see in the course. And I think that's often at times, I think people find it difficult. Oh, this is a really, really good argument, this is a really good piece of data, but how do I actually, or even really good piece of theory like the Psalms rule, right? How do I then, however, bring it back to my essay? The reality is you just need to find that kind of bit in the course that it connects with, use that kind of theory as a bit of a link, and then go from there.
Perfect. So hopefully this has been helpful. If you have any questions, let us know in the comments below. Love to help you. And stay tuned because we're going to do a similar deep dive on fiscal policy for 2024. So if you haven't already, hit subscribe and we'll see you in our upcoming videos. Till next time, see ya.